I can beat most traders with a coin, not a secret algorithm, not some insider information, not a $10,000 course, just a regular coin that you could pull out of your pocket right now. Heads, I buy. Tails, I sell. Same risk, same target. No indicators, no news, no magic. And here's the part that sounds completely insane. If I follow a few simple rules, that stupid coin will probably outperform what 80% of new retail traders are doing in the market today. When I first say that, people either laugh or get offended. They think I am disrespecting their effort. They say things like, I have spent months learning patterns, watching videos, studying charts. Are you telling me a random coin toss can do better than me? And the uncomfortable answer is yes, not because the coin is smart, but because the average trader is not losing to the market. They are losing to themselves. This video is about that ugly truth, and why a simple one-to-one coin toss strategy exposes it better than anything else. So let me paint a picture. Imagine I walk into a trading office filled with 20 new traders. Everyone has multiple screens, colorful indicators, news feeds, chat rooms, and coffee that is way too strong. I stand in the middle of the room and I say, I am going to trade against you all day using this coin. No indicators, no analysis. Heads I go long, tails I go short on the same asset you are trading. My goal is not to make a fortune. My goal is simply to not blow up. And I bet that at the end of the month, my account will look better than most of yours. Everyone laughs. They think I am trolling. But here is the twist. I am going to follow 3 rules like my life depends on it. Number 1. Every trade risks the exact same small percentage of my account. No exceptions. Number 2. My target is the same distance as my stop loss. If I risk $100, I am aiming to make about 100. That is what people call one-to-one risk to reward. But we will just think of it as equal risk and equal potential profit. Number 3. Once the trade is on, I do not move my stop. I do not stretch my target further out of greed, and I do not close early where there is no valid reason. I let the statistics do their thing. That is it. Those are the rules. Now compare that to what the average retail trader is doing. Let us follow one of those traders for a moment. Call him Alex. Alex wakes up pumped. He has been binge-watching trading videos. His social media feed is filled with success stories, cars, and screenshots of huge winning trades. He tells himself, this is my week. He opens his platform and starts looking for the perfect setup. There is an indicator crossing here, a pattern forming there, a moving average curling this way, a support zone that kind of looks like the last screenshot he saw. He feels the urge to be in the market. He does not want to miss the move. So he takes the first trade of the day, half planned, half impulse. He does not actually calculate his risk in a precise way. He kind of eyeballs it. He puts his stop where it feels safe and throws the target somewhere nicer. Maybe 2 times, maybe 3 times his stop distance, depending on how confident he feels. 5 minutes later, price moves against him a bit. Instead of taking the loss like a machine, he drags the stop further away. It is just noise, he says. Now he is risking more than he planned. The trade reverses in his favor. He is almost at break even, and now he cannot stand the idea of losing. So the moment it turns slightly green, he closes. Small profit, huge emotional roller coaster. Then he repeats. By the end of the day, he has taken 10 trades, broken every rule he wrote down in his journal, and he has no idea whether his strategy works or not. In other words, he is playing a chaotic game with real money. Now come back to me with the coin. I flip, heads, I buy. I enter with one fixed position size that risks, for example, 1% of my account. I place my stop loss under a logical recent level so I am out if the idea is clearly wrong, and I set my target exactly the same distance away on the other side. I do not care about the pattern. I care about the execution. Some trades win, some trades lose. With a coin on a big enough sample, I will be right about half the time. That means I expect to lose 1% about half the time and gain 1% about half the time before costs. That is roughly break even, maybe a little negative after fees and spreads, nothing special. But here is where it gets interesting. In that office, while my equity curve might be slightly up or flat, a bunch of those indicator-filled traders will already be deep in the red or completely out. How is that possible? It is because most retail traders are not trading a system. They are trading their impulses, their fear, and their greed with money. They change their position sizes randomly. They take revenge trades after a loss. They stop following their plan during drawdowns. They cut winners too early and hold losers too long. They constantly tinker, change indicators, switch time frames, and chase whatever strategy they saw last night. If you compare that messy behavior to a stupid coin with strict money management, the coin actually looks disciplined. And discipline has a value. It will not make you rich with a random entry, but it will often keep you alive longer than someone who is emotionally exploding on every candle. Think about casinos for a second. Casinos do not win because they always guess right on each game. They win because they structure the game so that they have a small edge, and they repeat it millions of times without emotion. A coin toss strategy with equal risk and reward is like a game with almost no edge at all. It is close to 50-50, but some traders have a negative edge because of their behavior. They repeatedly break basic rules that would keep them safe. They tilt, they over-leverage, they double down. If you put those two things next to each other, a neutral game played perfectly versus a negative game played emotionally, the neutral game will beat the losing traders over time. Let me tell you about an experiment I saw that completely changed the way I think about this. A trading coach gathered a group of students, and instead of teaching them some magic pattern, he said, "For the next 100 trades, we are going to do something very different. You are not allowed to analyze the market. You are not allowed to use indicators. You are not allowed to look at news. You will flip a coin. Heads, you buy. Tails, you sell. But here is the catch. You must risk the same small amount every single time. You must set your target at the same distance as your stop, and you must not interfere." The students were confused. They wanted secret knowledge, not a coin, but they played along. After 100 trades, some of their accounts were almost flat, some slightly down, a few slightly up. Nobody blew up. Meanwhile, in the same period, other new traders on the same instruments trading with full analysis and full emotion had blown most of their accounts. The lesson was painful but powerful. Entry alone is not what kills most new traders. What kills them is everything they do around that entry. So what does a one-to-one coin toss strategy really teach us? First, it separates the concept of an edge from the concept of behavior. The coin has no edge in predicting direction, but the rules around the coin create a structure that is more stable than what most retail traders naturally do. Second, it forces you to look at risk as a fixed, non-negotiable decision. When you risk the same amount every trade, you learn to think in risk units instead of dollar fantasies. A 10-trade losing streak hurts, but it does not end you. Third, it reveals how powerful consistency is. Even a zero-edge system looks decent next to someone who constantly breaks their own rules. Now, I know what some of you are thinking. Are you telling me to just flip a coin and trade like that? No, please do not do that with real money. The point is not to replace analysis with randomness forever. The point is to use the coin as a mirror. If pure randomness with good risk management can outperform your carefully analyzed but emotionally chaotic trading, then analysis is not the problem. You are. That is painful to hear, but it is also empowering because you can improve your behavior. Let us dig deeper into the psychology. Picture two charts in your mind. On the left, a steady line that wiggles up and down but slowly drifts upward or stays flat. On the right, a line that spikes up, crashes down, spikes again, and eventually drops off a cliff. The first one is your coin toss with strict one-to-one structure. The second one is the average beginner trader chasing setups. The beginner trader might have some amazing days where they feel like a genius. They hit a big winning streak, maybe catch a strong move, maybe double their account in one crazy week. But because their risk is not controlled, because they sometimes risk 5 or 10 times more than usual when they feel confident or desperate, a single bad day can undo everything. The coin never goes through that extreme emotional spiral. It never suddenly decides, today I feel lucky. Let me risk half my account. And that alone allows it to beat people who do. Here is another way to look at it. Imagine every trade you take as one chapter in a long book. Retail traders who blow up treat every chapter like it is the final page of the story. They react emotionally to every line. They rage quit. They rip the book apart. The coin toss trader treats each chapter as just one part of a long narrative. Win or lose, next flip, same rules. That thinking is what you actually need as a real trader, except you want to combine it with an actual edge in your entries. The tragedy is that many people are so obsessed with finding the perfect entry that they never learn how to think in series. They treat each trade like a lottery ticket instead of a piece of a long-term process. Let us talk about expectations. Most people come into trading thinking they will go from a small account to a huge one in a very short time. That expectation makes them do crazy things. They try to turn 100 into 10,000 in a month. They see stories of people doing it and think, why not me? So they ramp up risk. They break every safety rule. And just like that, they move from playing a fair or neutral game to playing a heavily negative one. A coin toss strategy with one-to-one risk and reward is almost boring by comparison. It is slow. It is patient. It does not promise crazy returns, and that is exactly why it is safer. The market rewards boring discipline far more than it rewards dramatic risk. So what practical lessons can you take from this coin story and use in your own trading without actually leaving your decisions to chance? First, lock in your risk per trade. Decide on a small percentage you are willing to lose on a single trade and treat it as a law, not a suggestion, not a guideline. A law. If that number is 1%, then one trade equals 1% every time, not 5% when you feel sure, not 10% when you want to make back a loss from earlier. 1. If you cannot do that, you are not trading. You are gambling with emotions. Second, clean up your targets. Many traders have stop losses that are close and targets that are miles away. It looks amazing when you draw it, but your actual win rate cannot support it. Try this for a while. Set your target initially at the same distance as your stop. Equal risk, equal potential reward. Once you have proven that you can consistently follow that, then you can experiment with letting a part of the position run further on some trades. But earn that privilege. Do not skip the step where you prove you can manage equal risk and reward like an adult. Third, track your behavior. The coin toss experiment works because the behavior is fixed. You can do something similar with your real strategy. For the next 20 or 30 trades, write down if you followed your plan 100% or not. Forget about the profit for a moment. Judge yourself only on whether you behaved like the coin. Consistent, rule-based, unbothered by single trade outcomes. You will probably notice that your losses are not random. They cluster around moments where you broke your rules. That is where you are leaking money. Let me tell you another short story that brings this home. A trader I know, we will call him Sam, struggled for years. He knew every pattern. He could quote every indicator setting by heart, but his results were terrible. One day his mentor gave him a challenge. For the next month, the mentor said, you are not allowed to take more than 2 trades a day, and you have to decide the risk and target before you click. If the trade hits the stop, you accept it. If it reaches the target, you accept it. No moving. If you break the rule, you stop trading for the week. Sam hated it. It felt like his freedom was taken away. He was used to taking 8, 10, 12 trades in a day, chasing every little move. But he followed the challenge. After a month, his win rate was not crazy, but something else had changed. His account was no longer in free fall. It was stable, even slightly up. He looked at the data and realized something shocking. When his trading looked most like that coin toss structure, equal risk and reward, fixed number of trades, no interference, his results were best. When he went back to thinking, overtrading, tweaking, and emotional entries, his results dropped. That moment broke his ego and saved his career. The point of this video is not to say that analysis does not matter. It does. Having an edge matters. Understanding market structure, liquidity, and context matters. But for most beginners, the missing ingredient is not another indicator. It is the ability to behave like a boring, disciplined machine even when your emotions are screaming. The coin toss strategy is like a brutal teacher that says, "See, the market does not care how smart you think you are. If you cannot control your behavior, even randomness with rules will beat you." So next time you sit in front of the charts, imagine that coin in your hand. Imagine how calm it is. It does not get angry after a loss. It does not double size to make the money back. It does not chase every candle. It just flips, follows the same rules, and moves on. Ask yourself honestly, do you trade with more discipline than a coin, or less? If the answer scares you, good. That means you have found the real area you need to work on. Because the truth is, the reason a simple one-to-one coin toss strategy can beat 80% of retail traders is not because the coin is lucky. It is because most traders never learn to respect risk, never learn to love small, controlled outcomes, and never learn to treat trading as a long series instead of a desperate sprint. Fix that, and suddenly you do not need the coin at all. You just need your edge, your rules, and the courage to actually follow them.